So, hello and good afternoon. I welcome you to today's Trading Spotlight webinar here together with Admirals. It's Friday, it's the 17th of June 2022. And today we want to dig deeper into, I think, a quite interesting topic, the difference between institutional and retail traders. And given the fact that I learned how to trade professionally, in fact, on a trading desk and thus among professionals, I hope that I can give you some insights on how these market participants think and how they in fact find the liquidity. What I mean with that, that's something we will dig deeper into then in the upcoming minutes, how they find the liquidity they are looking for and how to build, respectively, reduce their positions. That might be also something which is of interest right now when looking at the markets and seeing the overall meltdown we are facing. And so if you're now watching here the video on YouTube, if you watch the recording, please leave a thumb up here if you like what you will see in the upcoming minutes. If you have a comment, please feel free to leave the comment in the box below and ask all your questions. If you have any, then we'd be more than happy. In this case, I'm more than happy to answer all your questions. In addition to that, subscribe to the YouTube channel, set a reminder so that you don't miss any of the videos which we are producing for you. And that's it around the introduction, in fact. So let me share my screen, the first slide. Let's have a look here. And then dig deeper into today's topic and what we'll look into. So first of all, I'd like to introduce Admirals. I'm sure that many of you already know the broker Admiral Markets / Admirals. The broker saw a rebranding over the last year. Was it already 2 years ago? I'm not really sure. Because it's a broker which is in the financial industry here for over 20 years now, and offering over 8,000 financial instruments with a global presence with support on local languages, fully regulated broker, SISEC, FCA in the UK, ASIC in Australia, then also Jordan. All information's available on the website, admiralmarkets.com. Very competitive offering in trading in general. So we are not only talking about FX and CFD brokerage, but also in addition to that, about a very, very large offering when it comes to physical stocks via the so-called invest solution. So also check out the website here. What's also of interest here is the potential very interesting fractional shares offering. What this means, also all information available on the website. But coming back to the trading aspect, so I'm located in Berlin in Germany, and when we talk about Admirals here in Germany among traders, then usually we refer to Admirals as the so-called DAX expert. And that has to do with the fact that Admirals has a very, very competitive offering when it comes to DAX trading with very low spreads, very reliable platform stability. So you can be really sure that you face difficulties with the trading platform really at no time. So I wouldn't guarantee that certainly, but as long as I trade with Admirals, I have to say that we have a very reliable and stable platform. And then in addition to that, also a very fast order execution. Also, long thing short, check out the website, admiralmarkets.com, download the demo, check it out yourself, and then, well, the step over to the live account is also certainly a possibility. And one word, one broker, so fully regulated among the globe. You will find the offering from Admirals, but today's agenda is here about the difference between institutional and retail traders. And what we will look at here is, in fact, let's say a table, probably we can call this. I prepared here to show some key differences between institutionals and retails with a clear focus on institutional traders. And then I want to introduce you to a concept which is not, let's say, set in stone or something, but a level I refer to as institutional levels. What I mean by that, that's part. First of all, still we have to introduce some key aspects also in terms of risk management, for example, how professionals, institutionals in this context, manage their risks, in fact. And then I want to give you some ideas how to use this knowledge in your trading, and give an idea on how to spot these potential institutional levels yourself, and why you get to see a certain, let's say, a price action around these levels, especially into sometimes also the monthly close. That's also something we want to dig deeper into. I haven't prepared something separately around the rebalancing, which potentially takes place into the monthly close. But I would probably tell you about this a little, because in around 2 weeks from now, so not next week, but the week after that, into the not just monthly, but also quarterly close, probably we get to see some elevated volatility, given the fact that institutionals have to rebalance their portfolio, especially in the FX space. And yeah, that brings us to the first, last bullet point here, how to profit from this knowledge. So first of all, let's start here with the table I prepared. And let me also, by the way, check the chat box here. This is where you can ask all your questions now in the Zoom meeting. Let me just write down hello traders. So this is where you can ask your questions. Yeah, yes, thank you, Darshan. Viel Glück. Thank you. Good luck. That's good. Viel Glück is German for good luck in English. So now let's have a look here at this table, and let me just give you some thoughts. You can see we have institutional traders, we have retail traders, and so first of all, one main difference is certainly the available capital, which ranks between millions to billions. I'd probably say it's less millions, it's more towards billions, in fact. When I start to talk about institutional traders, in this case, main difference over to a retail trader is that I'd say, based on the data I've seen from brokers and which we can find via Google, that the average retail trader has an account size between 5 to 10,000. But even if we be significantly above that, for example, 500,000, it'd still be considered, in fact, a retail trader, even though a bigger retail trader for sure, but still this is not bringing you in the institutional world. And even if you're managing, I don't know, but that's probably a little ridiculous, but let's assume that you have kind of an account like around 10 million or so. That not necessarily means that you're an institutional trader, even though you probably start to wonder about a business model which potentially lets you profit also from a tax perspective, and so on and so forth, and probably bringing you into the range, but still the behavior might be very similar to an institutional, to a retail trader. Then what you usually also have is that these institutional traders usually are very short-term oriented traders. So this is not it is, but it's usually, which means, like, certainly there's also institutional traders which are sometimes very short-term traders, similar to retail traders. And then we're talking about high frequency trading, for example, in this context, or sometimes probably we're talking about specialized hedge funds, for example, which are probably trading intraday and looking for so-called move-to-move trades, like breakouts or something like that, where they try to trade into a progressive move, let's call this, and it can be also very short-term, but usually what you will see, what you will witness, especially if we're looking at an institution which is managing up to billions of USD, euro, not necessarily JPY, probably then we're talking about trillions or even more than that. But all in all, usually the time horizon is quite long and extended in this context. But still, the concepts which we will see here, you can also break them down and understand, for example, why, especially around the market opening, when we are now, well, we are headed to 20 minutes from now, we will see the Wall Street opening. And you might wonder, why do we get to see these volume spikes around the market opening? And that has to do with the fact that this is usually a time when many traders look at the market, when they start to act, when liquidity picks up, And this is usually then the environment in which institutionals start to, for example, reduce the exposure. So something like, give a short example in this context, like assume you have an institution, you can get all informations, sometimes also for free via websites like Finwiz, for example, that you have a small tab which reads for, let's say, I don't know, stock XYZ, institutional ownership, and it's quite elevated. Now let's assume it's a growth stock and you see a quite elevated institutional ownership, like, well, probably take Facebook. That's probably a good example because this happened several times over the last quarters with the quarterly earnings which were released. And then you see that they disappoint massively sometimes, in case of Facebook, for example. And they are massively reducing their growth outlook for their company. And you see a gap already sharp lower. And then these institutions start to wonder, okay, what do we do now when no one's there in the pre-market especially, or let's see the dust settles, if the market will rebound, see a rebound or whatever. And then you see that the market is not really bouncing. And you will see based on the upcoming minutes here, how they calculate their risk, that they then have naturally reduce their exposure. So they have to dump stocks, but they can't do this already in the pre-market or also in the after hours in a massive way. So they have to wait until the spot trading starts and there's liquidity coming into the market so that they are capable of unloading their exposure in this environment. And that being said, then also gives an idea on once we get to see short-term trading, even if your portfolio is overall longer term focused in such an environment, but also how you can profit from this environment. You can already spot it right here, because now you can see a retail trader is usually trading significantly smaller, and it's to some extent in the stealth mode. No one knows that we are there. So if I open my trading platform and I buy my I don't know, 100 Facebook or 500 Snap or whatever it might be, no one really cares about that. So it's not even, I'm not really having a big impact on the tape or something like that. It's not that I'm shining there or so. And this is definitely something we can use, because if we know that these institutions need liquidity, this is, by the way, also something we will dig deeper than in the upcoming minutes. But if we know that they need liquidity, and we know that these institutions are waiting for liquidity to come into the market, and we all see what this and that earnings release already has done, let's say, to a stock, well, we can be to some extent, not necessarily be sure, but we have an elevated possibility or probability in this case that the short-term momentum will continue, because they will likely to dump stocks and thus drive the price of the stock then right around the market opening lower, for example. And using this as a retail trader can be key, can be really your edge to use it then in the long term, in regards to the long-term growth of your trading career, respectively of your trading account, for example. So if we hear people saying, well, I have no chance in this environment because there are some institutions which are playing around with me, that's not true. Because if you understand how they act, and they have to act based on here, they manage billions of USD, and they're more long-term oriented, but still they have to focus on certain risk parameters. This is the third big difference between institutionals and retail traders. Then you can see that sometimes being a big guy in the market can be a big disadvantage in this context. Also, in terms of risk management, that's probably very interesting. We will dig deeper into value at risk in this context, and in what this is and how it affects your trading. But it's also that usually you will see that there's so-called multi-asset diversification. So it's not that they are betting on one stock. Let's say in the growth environment, let's have a look at the ETF, even though it's a bad example, because an ETF per definition is usually diversified among more than one stock. But you will usually see that such a multi-asset diversification, if it affects especially one stock, usually affects other stocks, especially if it's a big stock. It's not just a sympathy play in this context, but also if it's in the same well, sector, growth sector, probably we can call this. And if let's assume now that Tesla comes up with devastating earnings. I don't think that this will happen, but just imagine that this is probably due to the lockdown in Shanghai at the end of July. Growth outlook diminishes massively. Again, I'm not very confident that this will happen, but still, let's assume that just for illustration purposes here. And then you get to see this outlook, and such a growth hedge fund, for example, has to reduce its exposure in Tesla, but still has an optimistic outlook for the stock. So that being said, means it has to reduce its exposure in Tesla to some extent, but also to fulfill the risk parameters within the portfolio he's managing and towards his clients, for whom he's managing the money. Well, he has to reduce other growth names where he probably has an even worse outlook for the future. And that being said, then delivers a quite good idea on why these institutional traders are most of the time not using, as we retail traders do, so-called hard stops, stop loss. But in fact, they are managing it via certain risk parameters, especially around the value at risk approach, but also multi-asset diversified with stocks which are to some extent negatively correlated, and thus trying to balance their risk, let's say, but not with hard stops, but then using those mathematical models like the value at risk approach here to then dump their stock due to a certain level being hit, and thus they are forced to liquidate, in fact. So bringing this now here, so the question is from Darshan here, being a big guy is a disadvantage. Well, if you're big, you can hide. So that's what I mean. And you're also forced to trade based on the liquidity which is given in the market, which means that you have to wait till liquidity hits the market. And this is something where being big becomes a problem. While we as retail traders are not that big. So we can use this knowledge that big guys are, for example, seeing a problem here. Let's assume there was an earnings release which was bad. And then what you will see in this context is, for example, that they try to reduce their exposure already pre-market. And this is now where the pre-market volume in stocks, for example, comes into play. But they can't reduce it to the extent it's needed to fulfill the risk parameters within their fund. So then they start to dump really stocks and sell them aggressively right into the open when they know now around Wall Street opening, which takes place in around 50 minutes from now, they dump the stock because they know now there's lots of market participants, and their dumping of stocks is not causing to result in driving the stock significantly lower, and thus having a negative impact on their average price they get. So knowing that there will be natural selling pressure coming into the market can be of an advantage for us as retail traders, because we can easily get in and get out based on the small amount of shares, for example, we plan to trade. And that's what I was referring to in terms of being big is potentially also a disadvantage. While you certainly have advantages, you also have a disadvantage, especially if the market environment starts to significantly pick up speed and accelerate. And most likely also, we've probably witnessed this over the last weeks here. In fact, what I'm referring to, that they're now forced due to, for example, a crypto meltdown, and probably they have some exposure in the crypto space. They want to keep it because it's a long-term investment or for whatever reason. And then they have to dump other shares, for example. Then we're back in the diversification aspect in this context. So let's now have a look here at a very interesting concept, I think, when it comes to institutional trading. It's the concept of value at risk. And the question, what is this? So First of all, value at risk, VAR, is a measure of the risk of loss for investments. So very well, obviously it has something to do with risk and so on. So this doesn't help us out here. So in fact, when looking at it from a mathematical standpoint, it estimates of how much a set of investments might lose with a given probability, and based on recent volatility we have witnessed in this, well, let's say, basket of assets we are managing there, and given normal market conditions in a set period, such, for example, as a day. So that's again very difficult to grasp. So I have an example here. For example, let's assume I'm trading the DAX, okay, and we only focus here on one asset, and we are only focusing on the DAX in this case, but we can easily make this broader by documenting our trading in several asset classes, or in our overall trading account. We can easily calculate this given of how we trade and how the volatility in the equity curve presents itself, and so on and so forth. And we get an idea on the value at risk of our traded strategy, or of our traded approach in this context. So now let's just focus on the DAX and then say, okay, if I have, let's say, two strategies in the DAX that I'm trading. Let's assume it's an open range breakout system. I'm trading for a day. And then there's another approach. We once had here also a webinar in the Trading Spotlight webinar series on seasonal pattern, we can call this, how to trade the DAX, also based on the day of the week, and then how this could affect. In fact, you can draw a conclusion out of where's the advantage on the long or short side. And let's assume that's the open range approach, and then we have this day of week approach, or this daily seasonal strategy in this context. And now let's assume that given how I trade the strategies, also given the risk I'm taking per position and so on and so forth, I get a so-called value at risk. I can calculate this, and I'm not really sure. Probably we will do a webinar on this too, on how to program this. I'm not really sure if we did this already or not, but I remember we once did something around how to use Python coding, or coding respectively, a program here. We wrote a program together how to calculate the value at risk. I'm not, or was it around the value of, I'm not really sure. But however, so this is something we need to have some experience as a coder, at least. And then we type in these strategy parameters, and then we calculate the value at risk. And by the way, this is also something which explains why, for example, banks, investment banks, hedge funds, and so on and so forth are looking for quants, or looking for guys who have not a PhD in economics, but who have a PhD in, let's say, mathematics, or in physics, or in, I don't know, coding to some extent, like, what's the word for this? In Germany, it's called Informatik. I'm not really sure what's the English word for this, but like really quantitative approach. And the reason for that is because they use data, and then they calculate such formulas here and make sure that they are capable of calculating such a value at risk, for example. Now, coming back. Two strategies, I calculate the value at risk at, let's say, 8.92%. And this is no coincidence, it's real numbers. That means that given my strategies and how I trade them, and in my personal case, that I will, given the current hit rate and payoff ratio, so hit rate for sure is clear, payoff ratio is the average winning trade compared or divided by the average losing trade, lose 8.9% in 1 out of 20 months. This is so-called confidence interval of 95%. So you can see this is like in mathematics, when you were in school, and we're talking about probabilities and base and all that stuff. So that has something to do with that. Exactly. So you can look at this, and this is what I mean when I look at given market, given normal market conditions, for example, what I referred to here. This is like a normal distribution we're looking at here. And then based on the input parameters, how to calculate where the results you will find it. And then when we get to see an event which lies outside or within a certain area of this normal distribution, to put this simply, and So that means that if I look at these numbers, and I have a value at risk at 8.92%, that means that in 1 out of 20 months, given our that we can keep this volatility in the equity curve, or the hit rate, or the payoff ratio, that we can continue to trade with this, that I will then in 1 out of 20 months, with a probability of very high in this case, lose 8.9 or around 9% in my portfolio. And that now shows in this simple example how institutions calculate their risk. So that what they do is they have a set of stocks, for example, and then they say, well, given the volatility in the earnings releases, or not necessarily in the earnings release, that doesn't really matter, but in the overall trends and how the stock performed in the past, we can then calculate how big the risk, given a normal distributed market environment, let's call it, is that stock will trade, let's say, 10% lower from here. And then we combine this with other stocks we have in our portfolio, and then we start to calculate the so-called value at risk, and thus the risk that a certain event will take place in the future, given normal market conditions. So this is very important. So, and now what the institutionalists do now is they in fact use the VAR, the value at risk, to gauge the amount of assets which are needed to cover possible losses in their portfolio. And given that approach, that shows why they don't work with things like stops, hard stops in their trading, but they work with these models. And once a certain threshold is reached or breached, depends, then they start to reduce their exposure to fulfill certain criteria which they need to fulfill, given, let's say, the contract they have with an investor, and so that they are still within their risk parameters, which are measured with the value at risk in this context. So 1 second, by the way, I have to just write down some information here for my trading taking place today. You probably have wondered what I'm looking here at today. So stocks wise, I will definitely give Baba a deeper look after a very interesting quote, which we saw beforehand, with the PBOC saying that it accepts Ant Group financial holding companies application, and at the Ant Group is a potential spin-off, where the IPO was postponed in the end of 2020 as it's a spin-off from Alibaba. That's pushing the stock currently higher with a gap of over 10%. And then there's another candidate, but I'm not really sure whether the stock is so interesting to trade. In fact, as of now, at least, Roku. So there's some rumors that there might be a takeover taking place. And then they had also some news yesterday into the after hours with a new corporation in regards to an e-commerce deal with the Walmart, in fact. And this could also be interesting today. But as of now, it's not that actively traded, not even close to what we've seen in a pre-market volume in Baba, for example, with over 3 million shares. That's why, by the way, one of the reasons I'm talking about this here, but why I look at the pre-market volume, because I see elevated pre-market volume usually points to institutional interest. And that's why I'm so interested in that, because if I see that the institutionals already try to somehow position themselves in a certain direction in the pre-market, I expect here, if there's a fundamental catalyst, to continue in the upcoming trading minutes. So I use this information as well. But coming back to the value at risk. So now, value at risk here, let's say, given a very simple example, let's say we have a portfolio of stocks, and it has a 1-day 5% VAR of 1 million. That means nothing more for an institution that it has a probability of 5% that the portfolio will fall in value by more than 1 million over a 1-day period if there's no trading taking place. And formally here, a loss of this 1 million or more on this portfolio is expected, as shown in the slide before, to happen one day out of 20 days because of the 5% probability. And then what institutionals do in this context is, like portfolio managers, for example, they balance their portfolio, as I already said, in equities, bonds, commodities, and so on and so forth, given their investment profile, let's say, in which asset classes they plan to invest the money they have to manage. They balance their portfolios for their investors and adjust the portfolio allocation based on incoming data and given then the charts we get to see. So and this is in fact it. So they use data here to calculate of how much risk they're currently taking given most recent data, and then they say if now a certain threshold among these portfolios is breached, for example, and we're having more risk given the incoming data now in our portfolio, we have to reduce a certain exposure. Then, for example, given, let's say, the more in the current market environment, for example, you will look for more stronger, or you look for stocks which will likely perform better once the market starts to rebound one day or something like that, and then you reduce those where you expect now to not profit at all or profit less from a market rebound taking place. And this is then where the management of position and then the let's say interpretation of the incoming data comes into play for portfolio managers in this context. So now the question: what are institutional levels, or what can we do with all this information? Does it make sense to look at this? So while it's certainly interesting to look at the markets or at the exposure through the lens of an institution, you can't really make anything of this. And by the way, they won't tell you where their risk parameters are. You can only hope to somehow see them in the market and where the market reacts in a way where you have elevated volume coming in or something like that. But this is nothing they will tell you. This is like playing a poker game in the current environment. This is also something you have probably heard, you have read it in the news around MicroStrategy, for example. So the company, which is nearly all in long in Bitcoin, having an exposure of something like 130,000 Bitcoins or so. And then where market participants started to say, well, they have a margin call a level at around, I think, 20,000 USD for Bitcoin. Well, we have breached that level already, and there was no selling out of that Bitcoin. So selling out in terms of now MicroStrategy dumps its position in Bitcoin. And this is a very rough example, in fact, because MicroStrategy is not a hedge fund, even though it potentially behaves as one with its exposure in Bitcoin. But let's say they won't tell you that, because this is like a poker game and you're not turning your cards and showing them to your opponents and hope to win the game. So this is not how it works. But still, we get an idea on why, for example, there are certain areas in which we then try to position ourselves to profit from the, let's say, profit from the character of how institutions have to manage their risk in this context. So if we look here at these three key differences between institutionals and retail traders: available capital, time horizon, and how risk is managed, especially in regards to value at risk, then it becomes clear how, in fact, institutional traders think and how their levels they trade off come into existence. What they're not doing, this is something you probably have heard and read about several times, that they're hunting your stops. But no, they're not hunting your stops, but they are hunting groups of stops. That's potentially what they will do. What is meant by this? Well, groups of stops means that they need liquidity for the available capital they have to trade. They wait for liquidity to come into the market. They will then, you will see this around the market opening, that there will be sharp pushes on the up and down side. Right now, look at the chart, you will see that in the S&P, in the NASDAQ, in stocks, you may watch whatever, not necessarily in FX. That's probably another time window we look at here, probably then 4 p.m. London in this case, around the Big Bang. And this is probably also true for precious metals. But if you know these times, then you can see that there is elevated volatility and a pickup in volume due to the fact that these market participants need the liquidity around these within these time windows to build or reduce their positions. And so that's the second point. The reason why they are not hunting your stop, but groups of stops, is in fact that these institutionals need volume, liquidity, depth to execute the orders against before the market moves in the intended direction. And afterwards, you look at the chart and you say, well, this was stop fishing, no? Well, but this is not something you can really work with, or you can build your trade hypothesis around. And what I have here now is an older chart, and I have this for a reason, because if we look at dollar JPY right now, you will see that's nearly going vertical on the upside, because also the Bank of Japan is losing control over its yield. Over its yield curve, in fact, around its quantitative easing. But this is for no reason, because here you will see in a few seconds what I'm talking about. But respectively, you can now take a screenshot and probably draw the levels yourself, where you expect stop fishing having to take, where it took place, where you think it took place. Well, in fact, it's quite obvious. It was obviously here around this level. Oh, by the way, do we? Oh, okay. Now I see. Unfortunately, 1 second, please. I have to. Let's click. By the way, let me just also here do it differently. Let me put this here in the background. So, and now we're taking these out. Taking these out, and we're taking these out. So now let's assume, yeah, there we go. Okay, perfect. So here you can see that the market spiked into this level, and there was a sharp reversal taking place. So it looks like stop fishing, because now you say, what do you mean with stop fishing? Well, just assume you plan to trade the breakout for whatever reason. I don't even know. That was around, as I said, it's very, very old chart, 2019. But you can see here a spike on the upside and potentially a buy stop, and then we're selling off sharply. So now the next stop fishing level, well, you're shorting here the break lower, respectively, probably you are long, and you place your stop here below the most recent lows. That was that was in December 2018, last time when we saw this elevated volatility. So we're spiking here and then reversing higher. And now you can see here again also there was a spike below 108, around 108 then. And this is just, it's not that we know that there was stop fishing taking place, but these are levels which are obvious and where market participants can sometimes expect a so-called fake out to happen in this context. So this is what I mean by saying it's not set in stone, or this is not like a clear rule, but it's something like you have to train your eyes for to spot these levels which are potentially of interest. You can use other sources which will help you here. So for example, today is a special day. Today is quad witching in the S&P, respectively, also in the DAX, for example. What you can then do, for example, is saying, okay, well, if we are trading around these levels and they are available for all market participants and thus also for the institutional guys, and they are using them and saying, well, if we reach that level, if we hold above, then I expect some hedging taking place, and the option markets potentially bringing liquidity against which I can build a position or reduce a position. So you have to be to some extent smarter or think out of the box in this context. But this is definitely something you should keep an eye on based on the knowledge you now acquired on how they manage their risk. So it's not that they want to position here in this area and sell in this context against your buy stop and your 2 mini lots or something like that. But what they are looking for is really sell here against a group of people potentially betting on a breakout to happen, and then sell against this level and reduce dollar JPY exposure, not necessarily because they're betting here on a drop to happen, but because this is the region they have to aim for, they have to look at to reduce their exposure, respectively, to short here in this environment, because they expect market participants to be positioned in that area. Probably based on what you usually learn by reading a book on trading, for example. So if you read a book, so there's some very interesting literature, and it's all, I mean, completely makes sense. It's not that it's bad, but if you have like a book on price action trading, and it's telling you to use the last relative low, for example, to place your stop, or to buy breakouts by putting a buy stop, for example, at the most recent high. You can spot here weekly high, whatever, daily high. The thing is that these market participants expect many people to do that. And if many people do that, we're not talking about 3 mini lots anymore, but then we talk about big numbers, which are planning to buy here. And if we combine then this with the overall fundamental picture, respectively, with some not just sentiment, but also technical levels we're watching here, then we start to see such fake out moves more often than once. And also sometimes, and now the question is, how can I use this in my trading? And this is the next slide here. Well, we can use this information because, again, we are small and we can position ourselves once we spot such a fake out happening and liquidity being searched for from institutionals. We can use this for our advantage in this context, especially given the overall market environment. Like here, for example, if you see the spike out on the upside and then the market turning around and dropping sharply back into the trading range below, it's a potential fake out, especially if it's elevated volume you get to see here. In the FX market, it's a little difficult because we don't have clear volume data, but we can, for example, here look at how the future is behaving there. And then you get to see the spike on the downside. In case of dollar JPY, it's the JPY USD future, in fact, we are looking at here. But if you get to see some pickup in volume, this is usually a sign that there was lots of turnover being generated, and that if especially we drop back below the breakout level, that this is then a sign that further weakness is potentially about to come, respectively, that a reversal might take place. The same is true then when you look here at such spikes on the downside. Again, most likely these events happen when many market participants are watching here the events, which is usually taking place around big announcements. Bank of Japan, in this case, Bank of Japan, Fed announcement, like a central bank rate decisions taking place. And in case of dollar JPY, we have a high positive correlation when it comes to yield markets, for example, which means like employment situation, non-farm payrolls is of interest, and so on and so forth. The more buzz around the topic is out there, the more likely such fakeouts will happen, due to the fact that more market participants will be buying the breakout and then be fished out of position. And thus, the more interesting it gets for institutionals, because they say, well, we need these guys because, or some of them at least, because we have to manage our exposure accordingly. And so now the question is, at the end, how to profit from this knowledge around these institutional levels. And again, you probably now, I hope you're not disappointed, but it's really like, this is no big deal, but it's like thinking out of the box how institutions position themselves, and then try to put yourself in a position to think like an institutional and use the fact that you're a small trader to try to get into ahead of them, or with the reduced volume you're trading, being capable of really getting in and out of the market with no big problems, and thus also being capable of managing your risk accordingly. So just assume the following: just assume let's assume these guys are wanting to sell here, and they are seeing the market trading off. Let's assume that's a speculative trade, and they're short here, let's say from around 110, 112 or something like that, and they see this move here to happen. And now they see, okay, there's a bounce and we're not retracing here anymore. So we're not continuing to trade lower. They're potentially trading a trend which develops here. So, and they will have trouble to get out. I mean, this is a bad example because we're talking about one of the most liquid currency pairs around the world, but let's assume it's not that liquid here in this case. Let's assume it's a stock which is just trading something like, I don't know, 10 million shares or so. Not too sure if a big institution with billions of asset under management will trade low float stocks, but still, they have to wait until they can get out. It's not that they can just dump their position, but they have to wait until there is an opportunity for them to get out. For us, it's very easy. We just dump our position. We place our stop, and then we're done with the trade. And this is also a big advantage we have when it comes to trading compared to big institutions. They might have deeper pockets, but some of them are that deep that they will have trouble to manage their risk based on the given market conditions, and they have to wait until the market lets them out of the market. So now coming back here, how to profit from this knowledge. So first of all, keep things as easy as possible. Don't overcomplicate things. So what means in this context to spot these institutional levels in your chart is identify support and resistance zones in the higher time frames, which means like the big institutional guys are trading more volume, so they need more liquidity, which means they trade a higher time frame. Which means like we look at support and resistance areas on the H4, probably daily time frame here. And also what's of interest, then we're getting to the lower time frames, but the idea stays the same. We should also identify pre-daily, weekly, monthly highs and lows, in fact, because these are levels they're watching. And then we also have to have an eye on the economic calendar and potential market moving events. So it's in fact, as I already pointed out, not uncommon that the FX pair initially goes for a stop hunt. We identify a move here on the up or downside as a stop hunt, and then reverses independently from the economic print. The news are facts made around the price action in the media then. So the media talks about like the employment situation worsened, and that's why stocks pushed higher, because it makes a dovish Fed in the upcoming Fed meeting likelier. Okay, really? Like the employment situation worsened, you said? Yes. If we drop, well, sure, it dropped because the employment situation worsened, and that means a bad economic outlook, and thus stocks have to drop on this news, right? So the media tells you something around how to interpret the numbers based on where the market moved, but this is not an information we can work with as traders, in fact. But coming back here to these levels, so identifying them. And really look for levels which everyone is watching and which are objective. This is in fact key, in my personal opinion, to long-term success in trading. So a little anecdote here until we come to the summary of this presentation. When I worked at a professional trading desk where I learned trading, there was a story where we were talking about what we expect to happen for the DAX. That was years ago. And around that time, so I was a complete newbie, and I was thinking about, yeah, I have to understand this and really see the market through the lens of an institutional professional trader. And that's why I thought, well, I have to read the book on technical analysis. And back then, I started to focus on head-shoulder patterns and inverse head-shoulder patterns. And so then they were discussing on what to expect around the DAX and what's the current situation looking like economic-wise and so on and so forth, blah, blah. And then they looked at me, turnover, the senior trader, looked over and she said, hey, what's your opinion, newbie? And I said, well, I think we're headed higher from here because of this inverse head shoulder pattern, and really explained this in depth. And I was like, okay, that was good. I was really like, yes, confident. And she looked at me, not blinking with an eye, not smiling, nothing. Okay, that's great. Inverse head shoulder. Sorry, but what is this? And that she was trading for over 20 years as an institutional. She didn't know. She had never heard about a head shoulder pattern. She was just looking at me and saying, okay, great. So and what is this? Because this is not what these guys look for. They don't care about any lines we draw into the chart. Some they probably do, but they have to be obvious. So if you have any fancy pattern in your chart, this is usually not what an institutional trader looks at. This is, by the way, also true coming back to the current market environment. You probably heard about the S&P yesterday hiking rates. You have probably also heard that their foreign currency investment in USD is based for over 200 billion USD in FANG stocks: Facebook, Apple, Amazon, Netflix, Google, Tesla. So the S&P is a big hedge fund. They have to also publish a 13F disclosure to the SEC in the US. And now they're not looking for profits, but it was like exposure, they have to somehow have USD on their balance sheet, and we're looking for investments. So if they dump that now, because they become more restrictive for whatever reason, they don't care about the price. They don't care whether we are trading in a, let's say, bearish bat pattern, whatever, but they dump it because they dump it, because they don't care about the stocks anymore, because they want to reduce their USD exposure in this context. So that's something, definitely something to keep an eye on and think about before next time you spot such a pattern. I'm not saying they don't work, but they have to make sense in the overall context. And if it then corresponds with your overall approach to trading, great, go with it. That will definitely work. And I'm very confident and sure that it will. But most of the time, just drawing some lines and patterns into the chart won't get you anywhere, because this is not what the big money is looking for, which is making moves on the up, respectively on the downside. Yeah. And that's it around this topic. So let's sum up what we learned today. So first of all, there's no such indicator as institutional levels, but it's in fact more based on simple support and resistance analysis, knowing, for example, the pre-daily, weekly, monthly highs, and the knowledge around market moving events in the, especially a respective FX pair, but also for the overall market. And that's why I also motivate you to keep an eye, not just on the economic calendar you find on the website, admiralmarkets.com, but also on, for example, tweets from well-known and good informed sources, and sometimes then draw your own conclusions out of these sometimes important tweets, but they have to be from well-known sources. It's not that you have some financial Twitter guru telling you, well, the S&P is holding position, but it has to be someone who has lots of followers and who has a source, a credible source behind that, and then use this knowledge and build your own picture and thesis, especially around this. And coming back to the summary, so 3 key main differences between retail and institutional traders are, first of all, the available capital, the time horizon, and how they manage risk. And this then comes down to how institutionals think. In fact, for their trading, they need liquidity, depth, and this liquidity is found then in regions where you expect groups of stops, lots of liquidity being available beside market opening phases like we currently get to see, or also like these windows which open, for example, around the big bang, yes, FX markets, when hedge funds or also banks start to manage their exposure, and so on and so forth. And when you look at the charts afterwards, it looks like stop fishing, even though the only use these institutions, they only use the most obvious reason, in fact, where they can expect high volume to be traded, especially around market moving events. And that's the reason why it really looks like stop fishing, even though it's not necessarily. So they're just looking for the liquidity and where to find the liquidity and then go for it. And that's it. So here are the contact details from Admirals. Please feel free to reach out. If you have any questions, again, leave a thumb up here, leave a comment in the chat box below, subscribe to the YouTube channel. If you have any questions, if you have certain topics from our end to be discussed, shoot them over to Admirals, and then we'll build something for you around them. And fully regulated broker. So we'll finish here with a risk disclaimer, and that's it from my end. So all the best. Happy trading. Watch your stops. Have a nice weekend. Enjoy yourself. Talk to you again next week. I look forward to it. See you. Bye-bye.